Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right, welcome back to another episode of Wealth Wisdom. I'm Justin Obi, and today we have a huge debate with these two incredible gentlemen, Bill Ryan and Eric Benz with Fox Hill Wealth Management. Are equities better or is real estate better? Which is going to help me accumulate the most wealth? How do I create tax benefits? There's a whole, we get crazy in this debate, and it's going to be a fun one. So let's dive in right away. All right, so we were talking earlier before we pressed record, and it's real estate. Let's dive into the pros and cons of real estate versus equities over time. Bill, right off the bat, are you pro equity? Are all in on equities, or do you think real estate has a place in the portfolio? What's your overall view? And then we can dive deep into.
Yeah, give people a backstory too, your experience with each.
Yeah.
I'm so it's funny. I'm gonna start talking and I'm not gonna give an answer. You'll see. But because both. I think both are. You have to have both.
Both have their place.
Yes, 100%. Me personally, when I was in school, I was a finance major, and I remember thinking back. I'm like, oh, I'm definitely going to invest money right away. I also remember being like, oh, I really want to buy multifamily homes, right? I want to, because I had a professor who talked about multifamily homes and their advantages and things like that. And I was like, ooh, this is something I want to have a slew of multifamily homes that are paying me money each month and giving me that cash flow and all this other stuff. And it's going to be great.
That
and
passive income.
Yeah. So I graduated from school. I'm working multiple jobs trying to, I had my 40-hour-a-week job, and then I'm also doing taxes for people at night and on the weekends and things like that, and trying to make money every which way I can in order to save money for a down payment. And yeah, so back then you could get a loan, 3.5%. You still can actually for a first-time home buyer, 3.5% down. I saved that money. I asked a friend of mine, I say, hey, I can't really do this on my own. Would you want to, also invest with me? And we're looking at kind of up and coming markets. I live in Massachusetts. Justin, you live in Massachusetts. Yeah. Obviously, Eric, you grew up in New Jersey. You live in the Rhode Island area now. At the time, I said, okay, I started putting money into a couple different buckets, right? I had my savings. I was doing a Roth IRA at the time for my retirement savings, and my savings were also going to kind of be for the property, right?
Okay.
So looking at various places, like, oh, I want a fixer-upper, which, you can get some sweat equity and things like that. I was like, oh, I can get a little more value, right? That's what I was thinking. Looking back, especially these days with the cost of contractors and things like that, I would say the less you need to do, the better, right?
Interesting. Okay.
Because it's hard. That value is not there the way I feel like it used to be, just due to the cost of
today's market's a tough
materials and the cost of contractors and things like that. It's just extensive. But bought essentially what needed to be completely gutted, which I did, but took me 6 years, 7 years to
fix it up completely.
Oh yeah. So
would you have done it again?
There were definitely other houses I looked at that I should have paid more for and bought and wouldn't have had to, because what happened was I bought this 2-family, and again, this has been a fantastic investment if you look at strictly from the numbers, right? But if you look at what else I could have done in comparison.
Opportunity cost, baby.
Opportunity cost, right? Not necessarily that great. And if you talk to most people and said, oh, you bought a 2-family home in South Boston in 2007. Oh my God, you must have made a killing. You must have done this. That, you know what I mean? Everything's so great. Yeah. You're so lucky to have that, right? I was cutting tile at 8:30 at night, right? You know what I mean? Mixing mortar, trying to finish bathrooms, doing all, you know what I mean? Doing all this extra stuff that, again, like I think we talked about in a
Wow.
couple podcasts ago about sacrifice, right? Things that you have to do to get
Yeah.
ahead.
Yes, that's right.
And like I said, I'm cutting tile at 8:30, 9 o'clock at night, hoping my neighbors don't want to kill me as the screeching sounds of tile is being cut on a wet saw. But yeah, so I mean, tried to do as much work as I possibly could. I think I did like one unit, kind of did a lot of work, but I definitely had a lot of help. I had help from an uncle who helped me a ton, who was a licensed plumber, who he helped me do a ton of work, who I'm forever grateful for. And that did very well, you know what I mean, with that. But again, if I took all that money that I put for the, you know what I mean, and you got to live somewhere too, right? So that's always a consideration. So you're paying rent or a mortgage, some things that's always a cost that you have. But
Yeah.
all the money that you put into it, I just took that and I straight invested it. I don't think I would be too far off. You know what I mean, in terms of
Just if you had put it in the market.
in terms of my net.
But
Yeah.
okay, but there's did you live in the? Sorry. Go ahead.
Yeah, no. I lived there. Yeah.
Okay. So you lived there, and then you're fixing it up, and then did you rent out the other unit to?
So
While
initially,
you were living there?
Yes, yep,
Okay.
yep, to kind of help with the cost. So I had some friends living with me and stuff like that. And
Yeah.
there was, I mean, it was funny. We had a roof deck, right, that we put on early on, which was probably the last thing we should have done. But I mean, I can remember on Memorial Day weekend. I mean, I'm ripping apart this unit, and people are going up to party on the roof deck, and I have like
While you're doing
a dust
work.
mask on and stuff like that.
Wow.
So it was that was interesting, but yeah, no, I mean, and when you just look at the pure, and again, this was probably the very best time. I mean, South Boston had started to go up in value.
2007, South Boston.
2007, yeah.
Okay.
It had started to go up in value. It skyrocketed in the next 10 years, right? The value of places and things along that line. So,
So it was like an ideal case scenario, and you probably just beat the stock market, would you say?
if I have to look at all the numbers and everything like that. I mean, with cash flow and everything like that, since renting it out, it probably did, right? But I would say that was in leverage, right? So
Yeah.
what you're putting down, the property's still going up in value, right? Yeah. So in that case, right, have beat it, but honestly, not during that time. I think if I had invested some of that money, I want to say the market's up like 378%, or you know what I mean, or something like that from that time period.
S&P, yeah.
Yeah, if I was just taking that money, and then you consider the fact that I could have been doing potentially something else, right?
Mm-hmm.
I spent a lot of time, so my own like time,
growing
capital,
your own business too.
Yeah, things like doing
Yeah,
that. Like it wasn't like I took away. I mean, I was self-employed at the time, or shortly thereafter, where I started my own taxation business, and there were days like I would take a day off from work to go do that.
So fix up the house.
I could have been making, I don't
interesting.
know, $500, $1,000 that day, way back then, doing tax returns or helping small business owners or things like that, and instead of doing that. So when you take all those things into consideration, I really don't think I would have been too far off. I mean, but we are talking about kind of a great time for equities and a great time for real estate, and probably one of the hottest markets in the country. So,
yeah,
right. Eric, what's your experience been with real estate? How do you view real estate versus equities as a whole?
Yeah,
And then I don't have any into specifics.
Yeah, I don't have experience with renting. I mean, I've rented obviously, but and then my wife and I got our condo 2 years ago in Providence. But for this show, I wanted to create a scenario where we actually rent. Maybe we get another house or something. We're renting out this condo.
Yeah.
Which is the value is
or do you take the money and
$400K?
Drive it?
Yeah.
Well.
Yeah. So the value is $400K. Probably rent it for $2,500 a month. So, all right. So if you assume price appreciation is about 4.5% a year, which is what the appreciation of the real estate market in the U.S. has been the last 30 years, is about that amount.
Yep, I think that's fair.
And then you assume, okay, you're bringing in $30K a year from rental income. All right, now back out taxes, back out HOA. What I didn't include, which like Bill could speak to, is I didn't include like depreciation and stuff like that. I just did it down and dirty. So like my net from rental incomes is about 2,400 a year. Yeah, for the year.
Mm-hmm.
I have 24,000, not 2,400. So that's 5.9%
with your mortgage. You're talking about with your mortgage.
with the mortgage.
Like
No, not
in
even
terms of,
not even
I'm talking
including the
about a
mortgage.
pure
Net
cash. I'm talking
revenue.
about a pure cash flow. Okay, you're talking.
Yeah, not even that. The assumption is that I own this house entirely, no
Yeah,
mortgage.
That's
Yeah, but the
I wouldn't
24K
use that though, because that's not realistic for 99% of people.
Right, but honestly, this is like the best case scenario. So I'm earning 5.9% on rental income, plus the 4.6% price appreciation, 10.5 per. So it's like 10.5%, right, or 11% a year. I would rather be, in my mind, I'd rather be invested in the stock market and not have to deal with everything else that comes with real estate.
The headache.
Which
You're
is
saying
the headache,
you're making the argument to
maintenance,
just sell it.
lack of liquidity. Yeah, I'm going to sell the shit, put it right in the stock market.
Mm.
It just, I know I can be in aggressive growth stocks. That's where I want to be, and I know I can beat this return. My other thing with real estate is I view it more like private equity, right? It doesn't have the same level of liquidity that the stock market has. Like if I invest in stocks, I can sell that, take that out the next day. With real estate, it's not the same, right? You need to list it. It takes a lot
Not
longer
even
to get your
close.
money in.
But that's one of the reasons why most people like real estate, because they don't get to see what the value is every single day.
Right.
They don't know what the value.
Psychologically,
If they were to sell it, with the stock market, you see what you can sell it for every single day. So they say, "Oh
Right.
God, you can lose money. I'm down money. I'm up money." With real estate, you literally can't do that. So it's almost like a planned savings because of the barriers, right? So that's why people think like, "Oh, you can't lose in real estate." It's like, "Oh yes, if you did well with that property. If you had to fire sale that thing throughout the time you've owned it, there were plenty of times where you didn't, you know what I mean?
where it was down.
Yeah. Right? Yeah.
Yeah.
Well, it's also location dependent too. Some markets
Yeah.
have crushed, and other markets have done very poorly.
Yep, that's true. Yeah.
So going back, my whole anti-real estate, pro stock market investing is related to lack of liquidity. And if you're viewing it as private, like almost like a private investment, you should be getting a huge premium for that lack of liquidity. So if I'm going to invest in real estate, I want to be beating the stock market by a lot. Like I want to be beating it significantly. So there's a big assumption that I'm doing it correctly. I'm buying in the right spot. I'm working with a good accountant. I'm finding good renters. There just seems to be like way more variables than the stock market. Although you could argue you're bad at stock investor too. So it's like,
there's a lot of tax. There's tax. Yeah, sorry, Justin, you got it.
Yeah.
Well, I think just to your point, to compare it to private equity, maybe you have a slight point there. I think selling a business is much harder than selling a piece of real estate. Real estate's much more liquid than selling a business, right?
Yeah, but there's equity with real estate too. I mean, they don't.
Yeah.
Yeah,
well,
so I don't know.
Because you can only get out quarterly in a lot of those products and stuff. It's So that's why I'm viewing it like that.
No, I think it's a good comparison. I think there's probably other reasons for both, right? Like I think real estate, you have tax. What you were just going to say, Bill.
There's tax advantages, right? So
huge tax advantages.
This is, when Eric, you bring up your situation. My thing is this: it's rent received, okay?
Yeah.
Minus cost of getting it rented out, so advertising, commissions, and things like that to brokers. It's real estate tax paid. It's potentially HOA fees, if the homeowner association fees. If it's a condo or a townhouse, you may not have that. If it's a single family, multifamily, you've got mortgage interest on your note, right? That you can deduct, or you have to pay. You know what I mean? If you have a mortgage, which most people will do, and I would actually argue that you want to do because you can create leverage, right?
Yeah, you have more leverage.
You've got repairs, maintenance, which all these, whether you do it yourself or you pay someone, it's a cost. Cost of your time, or cost of their labor. You got taxes, home insurance, all these things go up against it, right? So let's say
Utilities, trash.
Yeah. So I mean, yep, exactly, right. There's all these costs that go up against it,
That
and those repairs, when you own a place, are not cheap. You don't have. It's very rarely do you have a $200 repair these days, right? Most, at least I mean in Massachusetts, to get a plumber to come out, an electrician, it's like a $250 minimum. You know what I mean? If you have
just for them to look at it.
Yeah, if you have an issue with your dryer, right?
$300.
Okay, so just for example, at my house, the breaker kept tripping, right? We had a repairman come out to look at our dryer, see what the problem is. It's $150 just for them to show up. Guy shows up. He says, "Hey, I think it's this thing within the dryer, right? This chip. It's $500 for me to replace it." Okay, I forget what it was. It was probably like a $300 part, and then $200 for him to come back out and fix it. We ended up actually just ordering it online. We thought it was that. We did it ourselves. Okay. Still keeps breaking, right? The breaker keeps. My wife actually just figured it out that it was because the socket was from vibrations was getting loose, and that's what was causing the tripping. You know what I mean? To go on.
wow.
But I mean, that was a lot of troubleshooting on our end, and you know what I mean? Things like that. We did pay for the part. You know what I mean? So, and this happens at rental properties all the time, and I know because I have 3 rental properties in total. Things like this show up all the time, and if you take into consideration every time you had a repair and it was $500, $1,000, $1,500, and you took that money and put it in the market.
Yeah.
That also, you know what I mean? You have to consider those things with an investment property. If every time you had a repair, instead of sinking it into the house and you were investing that money, those are things that people don't think about. They don't get
for sure.
They don't see that.
But okay. I mean, I manage 10 units as well, right? So I have a lot of experience. I've been doing this for 15 years, since 2009. So whatever that is, it's longer than 15 years, I think. It's not everyone says, oh, it's passive real estate. Like, I want real estate because it's going to be amazing cash flow. It's going to be passive. It's easy. It depends on if you're doing, like, how you do it. Like let's dive into that. Like, if you are investing in someone who wants to be the active owner, it might be passive for you, right? So in that case, but like I want you to dive into the tax intricacies of real estate, right? Like depreciation, because I think that's very unique to this asset class compared to equities.
Yeah. Yeah, so
and I think the two, and like also can you dive into, for people listening, like which is better, as a second part to this question, what's going to be better from an inflation defense standpoint? And maybe that's equal. I don't know, but I'd love to hear.
The other benefit, Justin, that Bill mentioned is the ability to take out massive amounts of debt for real estate. It's you can't quite do that with the stock market, right?
I can put 20% down or 25% down for a commercial property, and the bank is going to put in the rest at a very low rate.
And you own it, and you own it.
Which there is a cost, right? Like that's the interest that you pay, right?
Yeah,
for sure. But if you say, like, if I'm going to compare it to starting a business, right, and maybe you have to credit card. You got to take out a credit card to get the business going, or you're going to borrow it from an uncle, the seed money, or a parent.
Or even buying stocks on margin, right?
Right. But
that would be the equivalency.
Yeah. There you go. I think the leverage of real estate and the tax benefits are phenomenal pieces of it. But Bill, can you just unpack the benefits of depreciation? Like, how does depreciation work? Can you write it off against your active income or your passive income?
What's nice about real estate, right, is that you can have a positive cash flow on your investment. Okay, so all those costs I mentioned before, your mortgage payment, your principal and interest, your homeowner's insurance, your taxes, your repairs, all that stuff, right? The rent can actually be positive, okay, at the end of the year, and yet you still don't pay any tax. on that money because of what's called depreciation, right? So you get to depreciate the building value if it is a 4-unit or less. So a 4-family, a 3-family, a 2-family, a single family, a condo, townhouse, you depreciate that building value over 27 and a half years, right? So let's say, for example, the property is worth, and again, this is just easy math. It's not necessarily how it comes out, but it's a $275,000 building value. Okay.
Yeah.
You get a $10,000 expense that you get to write off against it. Over, you know what I mean? Every year for the next 27 and a half years. So you might be making $9,000 after all your expenses. You have $1,000 loss from a taxation perspective.
And where does that $1,000 go against?
So that can
you
go.
Also have a job.
Yeah. So I mean, it can, if you make up to so there's a passive activity loss, okay, which you can take. But if you make between $100,000 and $150,000, that loss can be up to $25,000 that you can take. But once you make $100,000, it starts to get phased out, and it gets phased out completely at $150,000.
Right.
If you aren't able to use it, it carries forward to the next year. Okay, so that $1,000 will go to the next year to offset future rents.
Okay.
Or it will continue to carry forward each year, right, until the year you sell it. And then that loss then is used up in the year that you sell the property. So you don't lose the loss, right? It carries forward, but you don't get to necessarily take it up against your income. There are certain designations, real estate professional, things like that, much harder, right, to get the, you know what I mean, where you can take potentially the whole loss in that year, right? But there's certain hours.
Because their income is considered active income.
It's active.
If you get the real estate.
Yeah, you're an active participant, but you're also, So you have to be
passive,
working in real estate. So there's certain jobs, right?
Yeah.
It might be like construction, might be an appraiser, might be a real estate agent. You know what I mean? There's certain jobs. But they also disallow certain jobs too. You think like, oh, a mortgage broker, they're really involved with real estate agent. Nope, doesn't fly. So
yeah,
it's tough to first of all get that. Are you in that certain job area? Are you spending the right amount of hours? You're spending 500 hours, 750 hours. So you have to really detail those things. So there's a lot that kind of goes into getting that real estate. So for the most part, the majority of people are going to fall into that passive activity. And that's where there are phase outs, right? You know what I mean? Or I shouldn't even say that you phase out on taking the loss.
Mm-hmm.
There's all sorts of different strategies, cost segregation strategies and things like that, where it's like, oh, the building value, but we're also buying, this. We don't have to take it over 27 and a half years. We could take this over 7 years. We could take this over 15 years, right? There's things like that to kind of help get those losses early going.
The depreciation.
Yeah. But that's some of the advantages. So you can have positive cash flow, right? But not actually be paying any tax on that tax year. So that's a really nice thing about real estate. Whereas if a stock pays you a dividend and it's in a brokerage account, not in a tax deferred retirement account, that dividend that gets spit off, well, you're paying tax on it that year, right? If you're in a mutual fund or ETF and they trade out of a stock, and that stock was bought at a lower amount, that spits off a capital gain distribution. You are paying tax on it that year, right? So that value of that house or condo, whatever it is, Eric could have bought it for $400K. If it has gone up to $475, you're not paying, right, any tax on that money until until you sell it. So same thing with the capital appreciation of a stock, however, mind you, right? So if a stock goes to 100 to 125, you don't pay anything on that, but you do pay on the income that is made.
Right.
So if it pays a dividend, you are paying, you're paying on that.
Sure.
Even if you're reinvesting the dividend, even if you're reinvesting the rent, right? You know what I mean? That doesn't matter. That's not part of the equation. That reinvestment only adds to your basis of what you paid for the stock, right? So if you paid for it 100, it shoots out a dividend and you buy more, right? So you got $3 in a dividend and you reinvested it in the stock. Your basis is no longer $100; it's now 103 because you paid $3, right, in tax, $3 in taxable income, which now is added to that investment on that stock. So
Yeah. Yeah. So pros of real estate, you've got just depreciation going against there's tax benefits to it.
tax benefits,
Depreciation.
leverage, right?
Yep.
'Cause
Automatic savings plan.
automatic,
Yep.
yeah, forced savings.
I would also argue it's probably in most cases it's a great hedge against inflation as well. Your the cost of all these things are going to always go up, right? The cost of maintaining your multifamily are going to go up. Your water bill, your utilities go up. The cost to hire the landscaper, the cost for plumbers and electricians.
But you're also hoping that your rent is going to go up, which in most cases that is.
Well, that's what I was going to say. In the right market, the rent should go up, and you should, if you're managing it correctly, you should be increasing the rents
If you
at
can.
appropriate times. If you can.
But if rent is not able to go up,
that's where I was going.
It's not a great inflation hedge. You know what I mean?
Well, yeah, because in the wrong market, I remember my first job out of college, I was a loan administrator. So for a commercial real estate bank, we were lending money to these big commercial owners. Yeah, and my job was client facing. So I was working with the owners of the people who are investors, the real estate investors, right? In certain markets, what they had to give away to rent units, and this is 06, 07.
Mm-hmm.
Free rent for 2 months, free cable, just to get that wasn't happening in Boston, right? So like
cost, yeah,
right, and that's like in certain markets, like so they say location, location, location. I think that's it's a risk of real estate. It's probably I would put it in the con column. You got to find the right market, and you have to be an expert in that market.
One big thing I want to say with real estate, and if people have ever heard of like the infinite banking concept or something like that, which is really nice, is that when your real estate does go up in value, you can do what's called a cash out refinance. And this is like one thing that a lot of people love about real estate is that
it's free money.
It's not free money. That's a very incorrect statement. You know what I mean? So that couldn't be further from the truth.
I'm trying to drum up a little back and forth here.
Yeah.
Tell people why it's not free money.
So here's the thing, right? Because a lot of times this is what happens a lot of times when people sell the property and they go, how do I pay all this taxes? I'm like, yeah, because you used up your equity. You know what I mean? Like over the years, right? I mean, I had a client.
Yeah. So define cash out refi.
So a cash out refinance is you go in, right? Let's say you bought the property initially for $500,000, and let's for all intents and purposes, let's say you put down 20%.
Yeah.
Okay. So your mortgage was for $400,000, right? So put $100,000 down. And again, I'm just trying to use easy round numbers. You put the $100,000 down. You have a $400,000 mortgage. You got let's just say you got a 30-year fixed, and 30-year fixed. You're paying 5%, or no? I mean, actually, let's use today's numbers. You're paying 6.5%, right? 6.5%. Mm-hmm. You've held on to it for 5 or 6 years. The market has done phenomenal, right? You're like, oh my God, my property has gone up. Let's say it's gone up 20% in value, right? So it's now worth $600,000. And you've paid down your loan a little bit, right, over those years. So now your loan went from $400,000 and you've paid it down to, I don't know, we'll say $370,000. Okay, so now you're at $370,000. You can do a cash out refi for up to 80%.
Loan of value.
80% or maybe 75%. Some banks will only loan on a rental property up to 75%. I think that's becoming actually more of the norm. If you know what I mean, if it's not your primary residence, maybe you're living in one half, right? And you can do the. But
it also depends if it's commercial or not. Yeah. Commercial.
100%. Yeah. The type of. Yeah. But let's say, for example, now it's 600. Now you can actually borrow up to 450. right? Because that's 75%
Right.
of 600,000. So now you have a $375,000 loan. You can say, okay, I want to do a cash out refi
Yep.
for a new 30-year. So you start over again, right? You start your loan over. You take the loan out for 450. They pay off the previous lenders $375,000 that they own. $75,000
Goes in your pocket.
Granted, you'll have some fees and things like that. So maybe it's not 375.
Yep.
Maybe it's not 75. Maybe it's 70. Okay.
So 70,000 goes in your pocket, tax free.
Tax deferred. So yeah, you don't pay tax on it at that time, which is nice.
I hope you guys are listening closely.
So we get any, you know what I mean? But when you go to sell it, your basis is not 600. Your basis is not 450. Your basis is, you know what I mean? It's still the 500. You know what I mean? So you've got that 75 out. You know what I mean? But your basis doesn't go up. You don't say, oh, when I sell a house, it's based off of what I paid for it minus what my mortgage is. It's based on your original basis of what you paid for it. Like I've had clients, and again, in the Boston area, like a lot of people will know who's listening to this podcast, right? People's real estate has gone up explosively since 2008. Right. So if you looked at the bottom of the market and where we are today, I was just talking at my kid's soccer game this past weekend, and one of the other parents, really, really nice guy, and he was just saying, he's like, I just look at the value of my house and I say, who is going to pay? You know what I mean? Like this much for my house, it's insane to me. You know what I mean? And I think a lot of people will probably agree with that statement, right? Whether they want to admit it or not. And a really good example is I had a client who had a multifamily home, kept doing cash out refinances, right? Probably pulled out hundreds of thousands of dollars. They went to go sell it. And I'm like, yeah, you owe 125 grand in taxes, right? Well, what do you mean? I only got 170,000 bucks from when I sold it. How is that possible? I'm only going to walk away, you know what I mean, with this much money. I'm like, yeah, every time you did a cash out refi, you were basically taking your sales proceeds out in advance. You know what I mean?
Yeah.
Well, not paying taxes, but the tax
You're
bill.
accelerating it.
Yeah, the tax bill was due right upon the sale.
Which, if you're investing that money, it's hopefully very good.
Well, that's the thing. You can take that, say, in going back, right? You take that $75,000, and now maybe you have a down payment for another property.
Yeah.
Right? So you haven't had to pay that tax bill, which everyone knows when they look at their check every week or every 2 weeks or every month when that comes in, you go, well, I made this, but I didn't get nearly what that gross is, right? I wish I got that gross, but my net check is substantially less. So you're able to take that money in the meantime, and rather giving it to the government, you have it. So then you can invest it. So if you think about the rate of return that you're getting on,
that's
that money.
This is where it starts to compound.
Yep, exactly, and that's where. That's nice. It's also too. If you have a brokerage account, okay, don't get similar. You can take a loan against your brokerage account. You will pay interest, just like you pay interest to the bank. You pay interest to your custodian or someone who can borrow it.
Security-backed loans.
You're talking about leverage trades now.
I'm just talking about a security-backed loan. Like they'll loan you up to 50%.
You're not supposed to put that back into the market. It has to be for something else. Yeah.
Mm-hmm. Oh, you're not supposed to. That's fair.
Yeah, I don't think they definitely don't want you to do that. Or
but
don't want it to come back into the account.
But say you don't want to sell. You have some positions, right, that have high capital appreciation in them. You still like the stock. You still like where the stock is heading and things like that, and everything looks good with that company. Right, they're continually, making more and more money. Their earnings are going up, which then in turn, hopefully, their stock price will continue to go up, right? Because that's what a stock price is. It's based on the projected future earnings of a company. And you say, hey, I don't want to sell that right now. I want to get this piece of real estate or whatever it might be. but I don't want to sell the stock and have a big tax
Right.
situation. Okay, well, they'll give you a loan and you can then take, you know what I mean? They'll give you a loan on your
Mm-hmm.
brokerage account and not, right, and
The,
not pay the
So
tax on
the
it. You just pay
the one
interest.
thing about those is they're variable. We have clients with security backed loans, and they some of them took them out when interest rates were really low during COVID, right?
Yeah, it's like prime plus one, prime plus
Well,
two,
two,
something like
yeah,
that, right?
yeah, it's plus 2%, 2.25 is what I last saw. So when interest rates were really low, you're paying like 3-4%, but now you're
mm-hmm.
paying like 8 or 9% interest on those. Um,
Hmm.
so it's important to remember that.
Oh,
Yeah.
yep.
So, okay. I mean, we started off. Which is better, right? Real estate or equity? Are they? I'm kind of getting the sense they're both good for different reasons.
100%. And I do think that just recently someone came out, they used to always be like, oh, you should have a 60-40 portfolio, right? Stock to bonds.
Mm.
I want to say it was like Larry Fink or from Blackstone. He mentioned, he's like, I don't really believe in the 60-40. I actually think it should be 50% equities, 20% bonds, 20% alternatives, such as real estate,
Yeah.
right?
30%
So,
alts. Yeah.
yeah, although that doesn't go to 100%. So maybe it was like
So
50
maybe
30.
30.
Maybe it was 50 30 20. I can add to 100.
Well, no,
Congratulations
I
to
think
me.
alts are. I think real estate is a great alternative asset to invest in, but
Yeah.
it definitely provides different.
So I mean, I think the advantages, like you said, is inflation hedge. You can do sweat equity, which you can't do with your stock, right? You can't be like, you couldn't go up to
Right.
Google and say, hey, what can I do to improve the earnings? You know what I mean? Like, those are some things you can do. Like,
Totally.
you don't need to hire.
You can buy the worst property on the block and
Yeah,
then fix it up and
you don't need to hire the landscaper. You could go in and you could spend your Saturday mornings if you wanted to,
sure.
going, mowing the lawn, keeping the place up.
Yep.
Something
Yep.
small happens, you go in, the door's loose, you can go in and fix it. So
Yeah.
that's some advantages there in which you get the sweat equity. You can
You
pay.
arguably have more control over it too compared to
Yeah.
equities. Right? Like I don't control what Google's going to do tomorrow. I'm just along for the ride.
Yeah. So I mean, so that the tax deferral, like the active tax deferral, how you can offset maybe current income. Because remember, I said there is a phase out, but let's say you don't make $100,000, you're actually taking a loss every year. So that's nice, right? You take
That's
a
great,
loss on your real estate property, that brings down your tax bill. So you may then get a higher refund, right, than you would have. That's a nice aspect. I mean,
Yeah.
everyone loves a good tax refund. And then you can take that tax refund and then put it into your savings, put it into, you know what I mean?
Mm-hmm.
So those are some nice things. You can have, like I said, you can have positive cash flow and not be paying tax currently on it. That's a nice aspect, right? That can help supplement you, help you pay your portion of the mortgage, and things like that. Those are all great things about real estate. The negatives are like the major costs that go into it.
Yeah.
So
And unless you're just investing passively into maybe a friend of yours who's a real estate investor and they're doing the heavy lifting, I would argue it is not a passive investment.
yeah, I mean,
Go out and buy a
I
multifamily.
I
It's not
utilize
passive.
I did it for years myself, but I know, Justin, you do it yourself for the most part, but I have a property manager
No, I do it
you know
myself,
what I
but
mean?
I've got people.
Okay, but yeah, so
Yeah.
but he takes a healthy fee,
I
and
don't lift a hammer.
okay, all right, yeah,
Nor would you want me to.
yeah, but but he takes a fee, right? And so it's become more of a passive, but stuff comes up, and then you know what I mean. If you're expecting like XYZ from your rent check, and all of a sudden you're like, oh wait, what happened last month? You know what I mean?
Mm-hmm.
Like this major repair happened, or things like that. I mean, that can be,
We should.
pretty extensive too. So,
Yeah.
and again, I say that in the two of the properties I bought. I mean, from a timing perspective, I couldn't have done them probably at a better time.
Yeah.
So
Right now is a really
kind of
hard
had,
time.
yeah, I kind of had a horseshoe up my ass, like when it comes to that. You know what I mean? That aspect. I think right now you have to be so selective,
Oh, it's very very hard to make it work.
extremely competitive. Okay, I mean the competition out there
What's
for
fierce?
a good cash flow property is, I mean, unbelievable. I have a story about a guy who wanted to buy, his neighbor told him, right? It was a friend of his, told him about a property that he should buy because he's in real estate development. And his neighbor goes, oh, you should talk. But this was a case. There was a husband and wife who lived there. They don't have any kids. Broken heart situation. One of them died. One of them died shortly thereafter. And he goes, he's like, you got to find out who this next of kin is so you can buy this property. It's a double lot. You know what I mean? This is something that you really want to look into. This was like the day the person died, a day or two after the person died. He finds out who the next of kin is.
Jesus.
Okay. Drives up to New Hampshire 2 days after the day of death. Goes up, hey, I wanted to move into this town. I want to, you know what I mean? Things like this. Unfortunately, you know
It's
what I
like,
mean?
you're the fifth person today.
It's a very competitive market. Oh my God. I wanted to move back into the town and from here. Goes up, person goes, oh my gosh, geez, I totally would have sold it to you, but I already promised it to somebody yesterday. You know what I mean?
Wow.
So, and it's like, he's like, holy smokes, the body isn't even cold yet. You know what I mean? So,
yep.
You can imagine the competition that's out there.
There's a line around the block when you go to these open houses for multifamilies right now.
Yeah.
Never mind it's
the auctions and things like that, right, that go on.
For sure. It's of course dependent on the market. Like some markets, there's still great deals to be found. But
it is compressed, right?
Yes.
Right. There's a lot of compression there.
We have a lot of economic variables that are affecting it. Okay, we got to wrap this up. I think overall, last takeaways, Eric, any last takeaways, Bill? Like final words here.
Equities win. Be invested in equities. Is that what we determined? No, yeah, there's room for both. Talk to your advisor. I still will probably be overweight the stock market versus real estate
sounds like
in my own
you prefer
personal
equities.
life.
And
yes,
there's definitely room.
I don't want the headache
to
of
have
stuff,
both.
and I'm okay with the volatility of the stock market.
I like the fact that I think there is room for both. That's my takeaway. Having listened to you guys right now,
I think there's room for both, but I do feel that equities, you will get a higher rate of return with less time
stress
involved. Maybe a little more stress, but
not if you have a good advisor.
Listen, I'm stressed out every day of my life, so is that you know what I mean? So no, I'm just joking, but no, I think you do get a higher rate of return when you consider all the times that you have to pump money in. You know what I mean? To a real estate property, if you were to then, but people don't think about that. They don't think about when they have to change the furnace over. You could have taken that money and invested it. It's not dead. You know what I mean? Like that money is no longer just like, it's gone. Yeah, you can depreciate it. Yeah, you can write it off against the rent. Okay, what if that was immediately making you money? It's different. So I think, but I do think equity investing takes a lot more discipline because you're fine with the ups and downs, Eric. There's a lot of people who are not fine with it.
Very true. Yes.
And so that's why when you talk about the importance of an advisor to see you through those periods, to make sure that you don't sell at the wrong point and things like that. Because real estate, you don't do it because you don't really have a choice. You know what I mean? So you're like, oh, I can't really sell right now. If someone was telling you, oh, you can't sell your stock right now, even though it looks like we're at death's door because we're in a down market because there's tariffs going on and there's this and that and whatever else is wrong with the stock market.
It's good to have a coach.
Yeah. If you were to stay invested and keep the capital appreciation again, look at the last 100 years on average, equities do outperform real estate. The reason why some people in their personal situations, real estate has outperformed is, again, all the work that they've done.
Yeah.
There's a value in that, right?
Totally.
So.
All right, guys. That does it. Thank you guys so much for tuning in. Next episode is going to be a banger. Stay tuned.
All right.
All right. Bye, everybody.